Welcome back to our Financial Fitness Bootcamp series for women. I'm Allison Donaldson, and I'm joined today by my colleague, Carrie Connell. We're both advisors at HTG Investment Advisors. And for those of you who haven't joined us for our other webinars, HTG is passionate about educating our clients and the community to ultimately lead to greater peace of mind when it comes to your financial futures. In this 5-week webinar series, we had hoped to educate, empower, and motivate you to get started to take control of your financial future. Last week, we focused on prioritizing savings goals and tips and tricks to optimize your savings. And today, we're going to consider what you do with that savings. When is it appropriate to invest? And when should you not? And how do you decide what to invest in? And as our other webinars where we'd like this to be as interactive as possible. So while we're presenting the content, Carrie's going to be fielding questions through the chat feature, which is in the bottom center of your screen. So please feel free to input your questions there and we'll try to answer them as we go along. Those are anonymous, so only Carrie and I can see them. First, I want to make the distinction that what we're talking about today is investing, not trading. There's a difference. They both have the same end goal to make money, but go about it in very different ways. Traders have their eye usually on short-term profits and often buy and sell securities within weeks, days, and sometimes even as short as minutes, while investors have a longer-term outlook. They think in terms of years and often hold securities through market volatility and cycles. Investing is about buying securities for the long term. They serve a purpose in your overall portfolio. So today we're going to be focused on investing to achieve your goals. To start us off, I'd like to share with you the 7 investment tenets that have been central to HTG's investment philosophy since our founding in 1993. And what clients love about these tenets is that they distill what can often be a really overwhelming topic to digestible, actionable items. And the tenets have an overarching theme: invest for the long term and focus on the things that you can control. First, you want to recognize that how you invest will depend on your goals. Then you'll want to use the scientific principles of asset allocation and diversification to your advantage. Always be cost and tax aware. And finally, realize that emotions and investing don't mix very well. And we'll take the next 15 to 20 minutes to run through each one of these in a little more detail. In a previous session, we discussed the importance of identifying and setting goals for your family, understanding the goal's time horizon, and quantifying the cost of those goals. Investing is personal. The way you invest will depend on your specific needs and goals. You want to arrive at the right mix of investments for you. What's right for your friend, your neighbor, your relative might not be right for you. And it all comes down to your needs, your goals, and your risk tolerance. Investing involves risk, and there are many different types of risk. Some you may be familiar with are company risk, the risk that a company that you invest in may go bankrupt and your stock holding goes to zero. Interest rate risk, the risk that interest rates will rise and your current bond investments with a lower rate will decline in value. This is something we're currently experiencing. Market risk, the volatility of the overall stock market. Currency and exchange rate risk, that would be for investments that are made with foreign currency. Generally, the more risk you take, the greater return you should expect. You want to get rewarded for that extra risk you're taking. We'll learn today the longer your time horizon, the more risk you can take. For short-term goals like having sufficient emergency fund, you really don't want to take much, if any, investment risk. For goals that are many years out, for example, retirement, you actually want to take investment risk, because if you don't, you're subject to a different kind of risk, not outpacing inflation and having your savings lose purchasing power by the time you retire. This is called purchasing power or inflation risk. And to maintain your current lifestyle in retirement, you want your savings to grow at a rate equal to or greater than inflation. So in short, the time horizon of your goal is going to be really important in determining your capacity to take risk, or how much risk you can take on. So let's look at why this is. To keep things simple, we'll consider three major asset classes: stocks, bonds, and cash. All have different volatility, which can be thought of as the magnitude with which they go up or down in value. Since risk and reward are related, the higher the volatility or risk, the more reward or return you can expect. So for example, cash or cash equivalents like money market funds and CDs are very liquid. They have a stable value and pay very little interest because they have very little risk. Bonds are loans to a government or company for a defined period of time and also pay interest. But at the end of the term, if you hold a bond to the end of your term, you're very likely to get your principal back. Depending upon who the issuer is, there may be a very high likelihood that you get that principal back. For other companies that are more risky, there might be a chance that you may not get your principal back. So bonds have more risk than cash and therefore pay a higher interest. Stocks represent ownership of a company or equity, and the shares may pay dividends, but they might not. But you hope that the share value appreciates over time. Over the long term, stock owners should get paid more than bondholders because they're taking on more risk. I'd like to acknowledge that many of the graphics we'll share today are from JP Morgan Asset Management, and we just find them very instructive, and they distill some pretty difficult concepts into visual aids. So we'll be using these today. This bar chart shows the volatility or range of returns of these three basic asset classes that we just outlined. In any one year, over towards the left, stocks are much more volatile than bonds, which are more volatile than cash. You can see the 1 year returns for US equities ranged from negative 39% in any 1 year between 1950 and 2021 to a positive 47%. For bonds, that range is a little bit tighter, negative 8% to positive 43% return, and cash between 0 and 14%. And I want to point out two interesting things. One, mixing investments, for example, here, 50% stocks, 50% bonds, represented by the bright blue bar, reduces volatility. And two, looking out over periods of time, over longer periods of time, the range of return is narrower and there's a smoothing out effect. Over a 10-year period, the equity range of return is negative 1% to positive 19%. And the 50-50 portfolio, for example, is positive 1% to positive 16%. So the likelihood of a positive return in a volatile asset class is higher the longer your investment time frame. So if you have 20 years to invest, you most certainly can withstand some short-term volatility, because over longer periods, that range of returns you experience is compressed. And this is called time diversification. The importance of setting goals and understanding when they will occur play right into this, because it will allow you to match your mix of investments to your time horizon. The longer your time horizon, the more risk you can take on. This chart, also from JP Morgan, visually depicts this. For very short-term goals, you want to choose safer assets such as cash or cash equivalents. You don't want a lot of volatility. You don't expect a lot of return. But as your time horizon increases, you can add more volatile investments such as stocks and bonds because you have the time horizon to wait out any short-term volatility. This concept is part of the science of investing. But there also is an art to arriving at the right mix of assets for you. You'll want to understand your risk tolerance. How do you feel in times of extreme market volatility? How do you feel during a market downturn? Investing does provoke strong emotions. And when we're experiencing a market downturn, some investors may find themselves making impulsive decisions or conversely becoming completely paralyzed and unable to implement an investment strategy or rebalance a portfolio as needed. This graph shows us how much the S&P 500, one of the primary measures of the stock market, was down at some point during a year. Those are the red dots we see on the graph. In virtually every year, we see the market has had a down period. However, the gray bars represent the final return for that calendar year. For example, in 2020, the S&P was down as much as 34% during the year, but finished up 16% by the end of the year. Over the years, we see that despite intra-year declines, the market has had a positive year in about 3 out of every 4 years. If you make an investment plan and fear grips you in a market downturn, you'll likely be tempted to sell at the wrong time. And you want to avoid reacting to short-term volatility. Some of us are wired for exhilaration, and others want a more quiet ride. And only you know how much of the ups and downs you can take and tolerate. In order to stick with your investment plan through up and down markets, you need to understand that tolerance for risk. This, along with risk capacity, will largely inform the right mix between equity and fixed income for your portfolio. I'm happy to answer questions as we go along. So if you have any, please put them in the chat feature. Diversification is another powerful tool for managing risk. There are different levels of diversification. First, to the extent that it's within your control, you want to avoid concentration in any one asset. So that could be your house, it could be employer stock. And if you are concentrated, then it may be that too much of your future depends on the performance of that one asset. And as we saw in the bar chart on volatility, you may want to have a different mix of asset classes to reduce your portfolio volatility, i.e. mixing stocks with bonds, which actually compresses that volatility. And further, diversifying within a broad asset class also reduces risk. For example, owning both large cap and small cap stocks or funds within the US equity market, or developed and emerging markets in the international market. The reason being that markets often behave differently from one another at any given time. Owning a portfolio with at least some exposure to many or all key market components ensures the investor will participate in stronger areas while mitigating the impact of weaker areas. It's a way to limit risk. So to demonstrate this concept, let's look at this very colorful graph, which we call the quilt for obvious reasons, again from JP Morgan. And it shows year by year returns of 9 different sub asset classes or parts of the market from 2007 to 2021. And each color represents a specific sub asset class. And without getting hung up on the details, we can see how randomly leadership can change among markets and market segments. The best performers are at the top of the column and the worst are at the bottom. In the first column, for example, 2007, emerging markets as represented by lavender, outpaced all other asset classes. But in the following year, it was at the bottom of the pack. The idea here is performance leadership is quick to change, and a portfolio that diversifies across markets is less vulnerable to the impact of significant swings in performance by any one segment. The light gray, whitish box in the middle represents a globally diversified balanced portfolio. It includes all the colorful boxes in each column. And you'll notice it's never at the top and never at the bottom. And unlike the emerging markets example, you get a much smoother ride. In the end, the second to the last column, we see the overall returns for these two portfolios over the entire period represented here are somewhat similar. On average, emerging markets returned 4.8% over this time period each year, and the diversified portfolio returned 5.7% on average each year. So you might equate emerging markets to the Colorado River and a balanced portfolio to the Mississippi. They both give you similar results in the end with very different rides. So you use diversification to your advantage to get that smoother ride so that you're less tempted to make impulsive decisions. Another way to easily gain diversification is to use primarily mutual funds and ETFs. Instead of picking a smaller number of individual securities, you own baskets of securities, which are automatically more diverse. And you can use both active and passive investment strategies to complement each other. So asset allocation and diversification are two very powerful tools in creating an investment plan. And those two things will determine a large proportion of your portfolio's return. But costs are important too. The lower your costs, the greater your share of an investment's return. You get to keep more. Mutual funds or ETFs have embedded expenses, usually expressed as a percentage that represent what different stakeholders like fund managers get paid. Index or passive funds typically have lower expenses, some as low as 0.03%. More actively managed funds can run as high as 1% or even over 1%. Some securities have transaction costs to buy or sell them. If the costs of your investments are high, they can significantly reduce a portfolio's growth over the long term. This graph illustrates how strongly costs can affect that portfolio growth. It depicts the impact of expenses over a 30-year time horizon in which a hypothetical portfolio starting with $100,000 grows an average of 6% per year. In the low cost scenario, the investor pays 0.25% of assets every year, whereas in the high cost scenario, the investor pays 0.63%, which is approximately the industry average. The potential impact on the portfolios over 3 decades is real, a differential of more than $50,000 between the low cost and the high cost scenarios. It's likely you may have some low cost investments and others with higher costs, but you want to make sure that your average cost is not too high. Another cost we have to think about is tax. To hold on to even more of your return, you want to manage for tax efficiency. Carrie mentioned last week that various investment accounts are taxed differently. We have taxable brokerage accounts that are taxed along the way, tax deferred accounts that are taxed when you take withdrawals, and some tax-free accounts if used for qualified reasons, like a 529 plan in HSA, a Roth IRA. For many investors, it may be possible to reduce your tax impact by allocating investments strategically among these different accounts. So holding relatively tax efficient investments in taxable accounts while keeping tax inefficient investments in retirement accounts. So your whole portfolio across both taxable and retirement accounts would include all of those asset classes on that colorful graph we just saw, but you would locate them in different types of accounts depending upon the taxation. In addition, in fixed income markets, tax-sensitive investors with higher incomes might also consider holding tax-exempt municipal bonds or bond funds in non-retirement accounts to lower taxes. So while we can't control markets, we can control the bite of costs and taxes to some extent. So asset allocation, diversification, and managing costs are the investment cornerstones for achieving your objective, but it only works if you stick with it over time and through a varying market environment. Our last tenet is discipline is essential to overcoming emotion. And this is a great chart from Dimensional Fund Advisors, one of our core fund companies, which shows the growth of the global equity markets since 1970. And each vertical line represents a world crisis. And through various crises, the disciplined investor, those who stay invested through the crisis, will be rewarded. We often refer to this chart with clients. How many of us thought when the pandemic hit in 2020, this time is going to be different? This is a totally different scenario. The world hadn't had a pandemic since before the stock market even existed. Yet in the scheme of things, look how small the impact was on the stock market way out here in 2020. It's a little blip. So the tools we talked about today encourage discipline and perspective, which can help you remain committed to your long-term investment programs through periods of market uncertainty. Yet we see on average, people don't do this. The temptation to time the market in some form or fashion, changing your investment plan in response to short-term market developments, is really strong. But abandoning a planned investment strategy can be costly, and research has shown that some of the most significant derailers are behavioral, reacting to short-term volatility, even though your circumstances haven't changed. The failure to rebalance back to your target allocation, the allure of market timing, getting in and out of the market, and the temptation to chase the latest hot investment. To see this, we turn to another chart which shows 20-year annualized returns by asset class, as well as how an average investor in orange would have fared. Over this period, the average investor earned 3.6% each year, as compared to 7.4% in a regularly rebalanced 60-40 portfolio represented in the bright blue. The differential is likely due to their making changes to their portfolio in response to market movements. Sometimes we really are our own worst enemy. So one approach to focus on steady savings regardless of current market conditions by making regular contributions to a portfolio and increasing them over time. This really does have a surprising impact on your long-term results. In fact, the earlier you start and the more consistent you are, the better off you are. We've seen this chart before. It compares different retirement outcomes based on various savings and investing behaviors of 4 people who save $200 a month, but at different times in their lives, for different durations and with different investment choices. The investor who winds up ahead is the one who saves and invests consistently over time and winds up with double the amount of the other savers. Appropriately named Consistent Chloe. Any questions here, Carrie? I'll pause for a second.
No questions yet.
Okay. All right. Well, that was the bulk of what we wanted to cover. We wanted to sort of outline some simple steps for you to invest in a manner that's appropriate for your goals and needs. Just to recap, you want to create an investment plan that fits your needs and goals. You want to match your allocation to your time horizon, diversify within asset classes, manage expenses and taxes, and last but not least, stay disciplined through market dips and swings. And that might be one of the hardest pieces to do. All right, well, we thank you all for joining us today. We'll send a follow-up email with a link to the recording tomorrow. Join us next week, same time, same place, for our last webinar in our series, which is Healthy Financial Habits for Kids. If you haven't already signed up for it, there'll be a link in our follow-up email tomorrow.
So we have one quick question.
Sure.
That just came in. Somebody is asking, what kind of recommendation would you have for someone who's starting to save sort of later in life in terms of how they should be allocated in their portfolio?
So again, I think it depends on your specific needs and goals. Often, and I'll give this example that might help. Often we see as you approach retirement, whereas when you were working and saving, you might have had a more aggressive allocation, let's say 60 or 70% equity, and the rest in fixed income. As you approach retirement, you need to start making withdrawals from your savings to live on. So we often ratchet down the risk in the portfolio to be perhaps a more even match, to take on less equity risk. If as you move through retirement, you see that you won't need all of your assets for your lifetime, your time horizon actually expands. You're actually investing for more of your legacy. So in those cases, then clients can often increase their risk even late in life because they don't need all of their assets for their lifetime. Hopefully that answered to some extent. Terrific. Well, thank you all for joining us. We'll be following up with an email tomorrow. Share the information with your friends and family, and please invite people to our next webinar if you think they could benefit from the information.